US markets snapped back in overnight trading in a 24-hour trading period that was a contrast in two halves. The Asia-Pacific session was tough. We saw pressure across the region. Australian shares down by 1%. The Hang Seng down by 2.2%. And that meant that European trading started off on a negative note, but it moderated over the course of the session. There wasn't anything to write home about in European trading, but that didn't stop US investors from piling back into the market. It was interesting to note the Dow led up by 1%, the S&P 500 and the Nasdaq only up 0.5% in contrast. But nonetheless, it's clear that there was buying intent in the US last night, and that's likely to flow into Asia-Pacific trading today. Now, a number of commentators pointed to the manufacturing PMI that came in higher than expected. I'd suggest that's an after-the-fact explanation. The reality is there were more buyers than sellers, and sometimes market action is that simple. It's just a balance, the marginal trade, and the marginal trade last night was buying. One of the reasons for the pressure on Hong Kong markets yesterday was a tax hike on telcos. That came at a tough time for the market and seemed to weigh on sentiment and trading there. But we also saw pressure overnight on gold, again down a further 4.5% and now well off those all-time highs seen just last week. Brent crude also tumbled down 4.5%, and it does appear that the greater likelihood of peace across the Middle East is weighing on the oil price at the moment. We could see further downward pressure there. In contrast, we heard from Palantir after market this morning. Palantir, the facial recognition technology group that's working with the US government, announced a better than expected quarterly revenue of $1.41 billion US. That's above estimates that are around 1.3 billion. But they also revised up with their estimate for full year earnings to about 7 billion. And that was well ahead of market estimates close to the 6 billion mark, and has seen Palantir shares trade 6% higher in aftermarket trading this morning. We'll have to see how it opens tonight, but it does look like the market will receive the result from Palantir positively. In local news, we have an RBA rate decision today. At the moment, interest rate markets are pricing a 75% chance of a 25 basis point lift in Aussie interest rates this afternoon. That's very much priced into the market. The Aussie dollar sitting just below 70 US cents, and the market, the share market, quite comfortable with the reasons why interest rates are going higher. So it does look like if it's in line with expectations, we might not see much of a market reaction. If the RBA does choose to pass, though, we could see a boost to shares in the afternoon trading session. So something to watch out for at 2:30 p.m. East Coast time today. But of course, earnings season is also a big feature of the market landscape at the moment. Tonight and into tomorrow morning in the US, we'll hear from Merck, from Advanced Micro Devices, from Pfizer, from Pepsi. So once again, we'll get a good read on those individual companies, but also on the broader health or otherwise of the US consumer. One to watch out for. It's also important to note that at the moment we are seeing very significant reactions to individual stock news. Meta and Microsoft were the example last week. There are more examples this week of companies moving by double-digit percentage changes in response to their earnings announcements. So it's important that investors are aware of when the companies they're holding are announcing their quarterly results in the US. But a focus for many people at the moment is the cryptocurrency markets, with Bitcoin coming under severe pressure. And it's being typified as a crisis of confidence. The Bitcoin hit a 10-month low in trading yesterday and is under sustained pressure. It's down 10.5% this year and 36% from last October's high at 126,000 US dollars a coin. So a lot of pressure in the market. Now, it's not, it doesn't appear to be a panic of any sorts, but there simply seems to be a lack of ongoing buyers. And although there is still seen as a US dollar alternative, the potential for it to ever become a global currency is very, very slight, given the very high processing costs of Bitcoin and the limited supply. It's also now being highlighted as a speculative instrument. I would suggest that that was always the case, but the fact that the market is now talking about these characteristics of cryptocurrencies tells us something about where market sentiment is. Now, not seeing any wildly bullish calls, unlike Those times when we're above 100,000, we had people calling for $1 million a Bitcoin. That's now looking pretty forlorn. And it's clear that at the moment, the momentum in Bitcoin at least is downward, although we have seen a bit of a bounce in trading this morning, back up to around 78,000 US dollars a coin. The problem for investors is that despite that bounce in the Bitcoin price overnight, crypto exposures did not go with it. Circles down 8%, Strategy fell another 7%, Bitmine Immersion down 9% all last night, and funds and ETFs are posting net outflows. But one of the keys to this equation is Strategy. It's the largest single corporate holder of Bitcoins, and its holdings are very significant. Now, in the past, Strategy had a business model where they would issue shares, buy Bitcoin, and their share price would go up by more than the value of the Bitcoin they purchased. And that dynamic meant they could keep purchasing. They were leveraging their Bitcoin exposures. The problem for Strategy now, and for the broader cryptocurrency market, is that Strategy shares are now trading at a discount to the value of their Bitcoin. And that suggests that the market has doubts that they could realize their Bitcoin holdings at current prices. In other words, if Strategy goes to sell, Bitcoin's going to come under further sustained pressure. And that's a concern for cryptocurrency investors, that if we start to get momentum and large holders are forced to sell, we could see a big change in the value and a big change in the outlook for cryptocurrencies generally. Now, it should be pointed out, Strategy does not have any significant debt due until 2027. It's not under any immediate pressure, but it's very clear there's a deterioration in sentiment in the crypto markets. And if Strategy responds to that, we could see another leg down to the current push south in cryptocurrencies. And so naturally, there are other shares affected. Coinbase is the largest crypto exchange and the first stock on our watch list today. It fell 3.5% overnight. It's down 17% for the year, and it has halved since its July high last year. So clearly there's been a big adjustment in the outlook for Coinbase from investors. The problem, of course, is that trading volumes on the largest exchange are plunging. There are a number of analysts who are maintaining a buy rating. To me, that looks a bit stale. I know more recently some have moved to a hold. Targets for Coinbase are all over the shop, and it just goes to show the uncertainty around not just their business, but the underlying crypto outlook. And with those volumes declining in line with the decline in sentiment and prices, it does look like at the moment momentum for these stocks remains negative. Moving on our watch list, the second stock we have is BYD, Build Your Dreams. It fell 7% overnight and led the decline in the Hang Seng, that 2.2% drop. The problem was sales. Sales in January were announced by the company at down 30% on the previous January, and a 50% drop in EU sales in particular, driving that decline. The share price is down 37% from the May high. And once again, we're seeing buy ratings, but I am concerned about how recent those ratings are. BYD clearly seeing negative momentum in its business at the moment. And the third stock on our watch list today is Xero. The local software hero is pushing its new AI-enabled services to turn around the business outlook. Now, this was a market darling. It's now more than halved in its share price fall. And it's clear that the management recognises they need to change the market story around Xero to re-establish a more stable share price. And so they're talking about the AI services, and the reasons are clear. The stock's down 18% year to date. It's using AI for all sorts of customer enabling functions, and is looking for an increase in revenues on the back of that productivity increase. Revenue estimates for the second half at 2026 have been confirmed by the company as likely to move up by 30%, and they believe they're well positioned to shepherd small and medium-sized enterprises towards AI. And clearly the management looking to position Xero as an AI-enabled accounting alternative in the Australian and New Zealand markets.